The retirement strategy that quietly saves people the most money is usually the one nobody brags about. It is not a high dividend portfolio. It is not a covered call fund paying a big yield. It is not some fancy income system that makes your account look busy every single month. In many cases, the strategy that makes retirement easier is much simpler than that. It is putting the right investments in the right accounts so you can control when taxes show up. And that may sound almost too boring to matter. But for a lot of retirees, this one shift can mean keeping thousands of extra dollars every year without taking more risk, without chasing more return, and without changing their entire life. Because the real goal in retirement is not to make your portfolio look like a paycheck machine. The real goal is to keep more of what your portfolio already earns. That is a very different way to think. And once you see it, you may look at every 401k, IRA, Roth, and brokerage account you own in a completely different way. In this video, I am going to show you why the popular live-off income mindset can backfire, why where you own your investments matters just as much as what you own, and a simple framework that can make your retirement more flexible, more tax efficient, and less stressful to manage. This is for educational purposes only, not personal tax, legal, or investment advice. What makes sense for you depends on your age, income, account types, and long-term goals. Now let's get into the part most people miss. A lot of Americans heading toward retirement have a very understandable goal. They say, I do not want to sell shares. I want my investments to pay me. I want to live off dividends and interest and leave the principal alone. That sounds safe. It sounds disciplined. It sounds like the responsible thing to do after spending decades building wealth. And emotionally, I get it. For many people, selling shares feels like failure. It feels like they are eating into the nest egg they worked their whole life to build. So naturally, a portfolio that throws off cash every month feels more comfortable. But comfort and control are not the same thing. A portfolio designed mainly to produce income can create tax bills on a schedule you did not choose, in amounts you did not choose, at times that may be terrible for your tax situation. That is the part many people never fully think through. The problem is not that dividends are evil. The problem is not that bonds are bad. The problem is not that income should never exist in a retirement portfolio. The problem is when the main reason you hold something is because it pays you now, even when that payment creates taxes you did not need to trigger. Because retirement is not just about income. Retirement is about after-tax spending power. That is the money you actually get to use. And there is a big difference between a portfolio that generates a lot of visible cash and a portfolio that leaves you with more usable money after federal taxes, state taxes, Medicare surcharges, and other ripple effects. Let me show you what this looks like with a different example. Imagine a couple in North Carolina. Let's call them Brian and Melissa. Brian is 65. Melissa is 63. They are about to retire with $2.4 million across several accounts. They have $1 million in Brian's traditional 401k. They have $650,000 in a joint brokerage account. They have $550,000 in Roth IRAs. And they keep another $200,000 in cash and short-term reserves. At first glance, this looks well organized. They have tax-deferred money. They have tax-free money. They have taxable money. That gives them options. But when we look inside the accounts, the setup tells a different story. In their taxable brokerage account, they own a high-dividend ETF, a preferred stock fund, and a bond fund because they wanted reliable income. Inside the Roth accounts, they hold a conservative dividend strategy because they thought it would be nice to let those dividends grow tax-free. And in the 401k, they mostly own a broad stock fund because that is where the growth has been. Nothing about that sounds outrageous. In fact, millions of Americans have portfolios that look a lot like this. But here is where things start to get expensive. The brokerage account is sending them dividends and bond interest every year whether they need the cash or not. That income lands on their tax return automatically. They do not get to press pause. They do not get to say, not this year. They do not get to choose a lower income year to recognize it. The money shows up. The tax form arrives, and the IRS gets involved. That matters a lot more than people think. Why? Because bond interest is generally taxed as ordinary income. That means it is taxed more like wages than like long-term capital gains. Now, so Brian and Melissa are holding one of the least tax-efficient parts of their portfolio in the one place where annual taxes hit immediately. Then there is the high dividend strategy. Some of those dividends may get favorable tax treatment. Some may not. But either way, the broader issue remains the same. They are creating taxable income on autopilot, and that reduces their control. Now think about what happens if Brian starts Social Security, Melissa starts drawing from a taxable account, and they also have enough income to push up their Medicare costs. All of a sudden, what looked like a simple income strategy starts affecting tax brackets, premium surcharges, and planning decisions all at once. This is why a retirement portfolio should not just be judged by yield. It should be judged by flexibility. And this is where one of the most overlooked planning tools comes in. Not asset allocation. Asset location. Asset allocation is how much you own in stocks, bonds, cash, and so on. Asset location is where you place those investments across different account types. That distinction sounds small. It is not. Because in the United States, different accounts live under very different tax rules. You can think of retirement assets as living in 3 neighborhoods. The first neighborhood is pre-tax. That includes accounts like a traditional 401k and traditional IRA. You have not paid taxes on that money yet. When money comes out later, it is generally taxed as ordinary income. The second neighborhood is tax-free. That is your Roth IRA or Roth 401k, assuming qualified withdrawals. This is precious space. E-growth there can be permanently tax-free. The third neighborhood is taxable. That is your regular brokerage account. This one is more complicated. Interest and dividends may create taxes along the way, but appreciation often is not taxed until you choose to sell. And if you hold for more than a year, you may qualify for long-term capital gains treatment. That last part gives you something valuable. Choice. And choice is one of the most powerful tools in retirement planning, because the more choice you have over when income shows up, the more room you have to manage your taxes, control withdrawals, respond to market changes, and make smarter decisions year by year. So, what kinds of investments tend to fit best in each place? Let's keep this very simple. In a taxable brokerage account, many retirees benefit from owning tax-efficient investments. That often means broad stock index funds, especially those with relatively low turnover and modest distributions. These investments may still produce some dividends, but they are usually not built around maximizing current yield at all costs. Why is that useful? Because a taxable account is one of the few places where you may be able to decide when to realize gains. That means you can wait. You can plan. You can choose your moment. But that benefit is weakened when the account is stuffed with investments that spit out taxable income every year, whether you want them to or not. In pre-tax accounts like a traditional 401k or IRA, income-producing assets often make much more sense. This can include bonds and other investments that would otherwise create ordinary income in a taxable account. Inside a tax-deferred account, that annual tax drag is delayed. The investment can do its work without sending you a tax bill every year. And then there is the Roth. For many households, the Roth is the most valuable account they own because it is the only bucket where future qualified withdrawals can be completely tax-free. That makes it an especially attractive place for assets with the most long-term growth potential. In plain English, many people do not want to waste Roth space on investments that are mostly there to generate current income. They want Roth dollars working on the assets that could compound the most over time. That is why so many people accidentally place their portfolio backward. They put conservative income strategies in Roth accounts because it feels safe. They put bonds in taxable because they think of them as simple. And they leave growth in pre-tax accounts without realizing how much future tax that growth may eventually carry. Now, does that mean everyone should run out and rearrange every account tomorrow? No. This is not about making reckless changes, triggering large gains, or pretending there is one perfect layout for everybody. This is about understanding the principle so future decisions get better. Sometimes the fix happens gradually. Maybe new contributions go into different funds. Maybe dividend-heavy positions are not automatically reinvested forever. Maybe over time, as part of a withdrawal plan or a Roth conversion strategy, the portfolio becomes more intentional. And that brings us to one of the biggest objections people have. They say, I understand the tax point, but I still need money to live on. I need income coming into my checking account. Absolutely. But there is a difference between receiving cash and surrendering control. One of the most helpful concepts here is this. Instead of forcing the portfolio to manufacture income on its own schedule, you can create cash flow on your schedule. Think of it like this. Imagine you own a rental property. You would never say the only smart way to benefit from that property is to collect rent and never sell anything, ever. You would understand that value can come from both income and appreciation. A portfolio works the same way. Total return matters. That means growth plus income together. So if you need $4,000 this month from your investments, one approach is to own a fund that distributes cash whether you need it or not. Another approach is to own a more tax-aware investment and sell only the amount you need when you need it from the tax lot that makes the most sense. The cash in your bank account may look the same, but the tax story behind it can be completely different. When a fund pays a dividend or bond interest in a taxable account, that tax event may happen without your input. When you sell shares intentionally, you can often decide how much to sell, when to sell, and which shares to use. That level of control can matter in more ways than people realize. It can affect how much of your Social Security is taxed. It can affect whether you stay in a lower tax bracket. It can affect Medicare premiums through IRA. For retirees under 65, it can even affect health insurance subsidy planning. In other words, the retirement question is not just, how do I get cash? The deeper question is, how do I get cash in the smartest way? That is why this strategy feels boring. It does not feel exciting because nobody is promising an 8% yield. Nobody is selling a magic fund. Nobody is making your account look flashy. But boring is often exactly what works in retirement, because retirement success is usually not destroyed by one dramatic mistake. It is quietly damaged by dozens of small inefficiencies repeated year after year. Too much taxable income. Poor account placement. Unnecessary distributions. More taxes than expected. Higher Medicare costs than expected. Less flexibility when markets fall, and less flexibility when life changes. And life always changes. Maybe one spouse stops working earlier than planned. Maybe Social Security starts later. Maybe 1 year includes a home sale. Maybe 1 year includes big medical costs. Maybe tax laws change. Maybe markets surge and suddenly harvesting gains becomes more attractive. Maybe markets drop and suddenly selling income products at the wrong time feels terrible. A portfolio that gives you more control is easier to adapt. That is the real win. So here's the simple takeaway I want to leave you with. Do not just ask what your investments are. Ask where they are. Do not just ask how much income they pay. Ask what kind of tax footprint they create. Do not just ask whether your portfolio feels productive. Ask whether it is efficient. And most importantly, do not confuse automatic income with intelligent income. The best retirement plan is not always the one that pays you the most on paper. It is often the one that lets you keep more after taxes, adjust more easily, and make decisions on your own terms. That may not sound exciting, it may not look exciting, but for many Americans, that one shift in thinking is the difference between a retirement that feels tight and one that feels flexible. So before you chase another high-yield fund, before you assume dividends are the answer, and before you build your entire retirement around the idea of never selling shares, take a closer look at the structure underneath your portfolio. Because the strategy that changes retirement is often not about earning more. It is about leaking less. And once you understand that, you can start using your accounts the way they were meant to be used, not as random containers, but as planning tools. That is where smarter retirement income really begins.